Welcome to TheoTrade. This is Don Kaufman. Here we are. It's May 6, 2017. I'm doing the Theo weekend video update. First and foremost, what I kind of call the tale of three indices. We're going to start this kind of weekend update with a quick look at three major index products. And for that, I've actually gone and used the ETF products. So let's go ahead and explain what's what. On the top of your screen over here, we are looking at the Nasdaq, the QQQ, right smack in the middle of the screen, of course, the spiders. And on the bottom of your screen over here, we've got the IWM, of course, representative of Nasdaq, the S&P, and the Russell, respectively. Now, it's, again, really what I call like the tale of three indices, complete in utter divergence this trading week. You know, if you watch the S&Ps throughout the course of the trading week, which a lot of people did, and again, I'll kind of highlight this in the S&Ps over here. What did the S&Ps do much of the trading week? Absolutely nothing. I mean, trying to trade on an intraday basis this week was a lesson in futility if you were trading S&P futures, as for the most part, they had absolutely no range, literally until Friday afternoon with an hour to go. They rallied a couple of points. Anyway, the S&P's fairly boring. Now, it's, again, this tale of divergence where here we actually have, of course, the Nasdaq ripping to the upside, the Russell actually descending a little bit lower. Very, very peculiar, because in almost every instance that you look, and again, this just happens to be a 3-month comparison chart. And when anytime you do a comparison chart, first of all, comparison of three different products, 1, 2, 3, is always going to be done on a percentage basis. And over the last, again, 3 months, you can see, you know, on top over here, the Nasdaq, you know, up 9%, the S&Ps are up about 4.7%, the Russell lagging only up about 2%. Now, the point being, anytime you look at a comparison like chart, is the first data point, which I'm actually highlighting on the screen, that's the beginning of the comparison. So the most interesting thing, again, of course, is this divergence. You know, you see divergences in index products all the time, but such a massive divergence in such a short period of time, okay? What's really going on over here is capital, okay, rotating out of the Russell into the Nasdaq. It's clearly not, you know, doing anything to the S&Ps at this point. But lo and behold, what it really breaks down to is right now, okay, you know, let's forego any earnings discussion and, oh, there was Apple. It wasn't really that exciting, but the stock's at all-time highs, yada, yada. The point being, okay, at any cost, at any risk, people are throwing money towards the Nasdaq. They're not currently throwing money towards the Russell. You know, the S&Ps have been, I mean, the volatility in the S&P is astoundingly low. And this is the starting place, you know, for thinking about the future of the marketplace. And the reason, you know, this is, again, obviously we're looking backward over here at the, you know, Nasdaq ripping, but it's highly unusual to see such a large divergence in such a short period of time in the major indices. And I feel like, again, nobody seems to be pointing this stuff out. And you start to look at the products individually. And again, in the Nasdaq, the only phrase that can kind of come to mind is throw caution to the wind. No one cares. They're buying stuff in the Nasdaq literally at any price. And it is, you know, reminiscent, of course. And I started trading in the late 90s. Of course, it's reminiscent of the late 90s. You know, throw caution to the wind. Buy eToys. Well, yeah, sorry, we don't have eToys anymore. They went bankrupt. So what do we do now? We throw caution to the wind. What do we do now? We buy Tesla. And obviously Tesla, after the earnings announcements, things got a little dicey for 3 days, but that's okay. They rallied it back up. This happens to be an entry I am looking for a short position inside of Tesla. And I'm going to look, you know, at this, okay, on this being Friday. Okay, so this is Friday's trade. I'm going to look at this come Monday and see if there's any follow through to the upside. If there's the slightest bit of follow through to the upside on Monday, I'm actually going to short into it. And the big, you know, decisive factor is, do you short into it using stock? Because clearly Tesla is an extremely high risk product. Okay, I do have the capital to allocate into stock, Or do you go at it a little bit safer? Do you go and use just something like an in-out spread? For most people, that is going to be the safer place, is going to be use something like an in-out spread. So if this is just a $2.50 wide spread, you don't want to pay more than about $1.25 for it. But if you want a little bit more risk on the table, you do something along the lines of like a $5 wide spread. And a $5 wide spread, you don't want to pay more than about $2.50 for. It's just an in-out put spread. It'll buy you, 34 days of being bearish inside of Tesla. Can you get run over? Yep. And I've been run over before by Tesla. Okay. However, I look at this and, are we at the end of the rally here for certain in Tesla? Absolutely not. But at this point, given the fact that they have better, market valuation than GM and Ford, and you have to laugh about that one a little bit. Obviously, it's difficult to value something like Tesla. Okay. But I'm willing at this point to step up to the plate and actually short shares of stock. One thing that always, concerns me, I'm like, are there shares to short? There were some very, very large short positions in Tesla until this explosive move from that 250 level, taking it to 300. That's right about the time Elon Musk said something about a tweet, not such a warm, fuzzy day in Shortsville, along those lines. Nevertheless, let's move on. So again, in the index products, as I was saying, throwing caution to the wind inside of the Nasdaq right now, okay? The big looming question is how long can that last? And I'm going to bring up the Nasdaq futures. And frankly, I'm short. One of my largest short positions is in the Nasdaq futures. Short and obviously taking a bit of pain to the upside. This latest move clearly from, the 53.50 all the way up to, that's right, 56.50. That's a straight shot. This is a daily chart. Okay. This is a straight shot up 300 Nasdaq points. Okay. The largest drawdown at any point in here has been a 2-day window where they came off from 56.30, okay, down to 56.09. That's the largest period they've come off. And we're arguing about, is it overbought? Are people throwing caution to the wind over here? There's no argument at this point. It's just a matter, okay, of do you want to step in front of the freight train? And how do you actually want to do it? Do you want to use a defined risk spread? For most people, that's going to be reasonable. If you've got the capital to put at risk and you don't mind taking some heat, me, 300 points of heat, it hurts. I'm short a 4 lot inside of the Nasdaq futures against 300 points. Do the math really quick. You're like, ooh, that's not going to be good for anybody. You know what? This is a much more duration position. And that simply means, okay, I'm going to be holding my Nasdaq futures because, simply put, I've been around in the business for a long time. I have seen this movie before. And I've seen a product like this that feels so overbought that nobody wants to touch it, and it'll shoot up to 5,800. Why? Just because you're short. And it, of course, feels that diabolical. Nevertheless, okay, the Nasdaq, in a complete and utter divergence from the other index products, makes me feel a little better at this point in time about being short the Nasdaq, because those divergences, they're not going to last a substantial period of time. My biggest concern right now, and I've been voicing this over the last few weeks, okay, in a lot of the videos we're doing here at TheoTrade, the XLF. The financials can really change my perspective substantially about risk moving forward. And it comes down to this 24 level here inside, specifically inside of the financials. And I've mentioned this time and again, if the financials breach the 24 level, which they did, albeit extremely briefly. You had a period over here, 2 weeks ago, you're like, boop, above 24 for a brief and fleeting moment. Once again, it happens the next day, above 24, cannot sustain it. Falls out of bed to the mid 23 levels, we bounce again, can't sustain 24, tried again yesterday. The interesting thing is the S&Ps, they rallied yesterday into the close, but it had nothing to do with financials and everything to do, once again, with technology, the Nasdaq. What else helped the S&Ps yesterday? The bounce inside of energy, which I'll come to here momentarily. But when it comes to the financials, okay, if we break above the 24 level, that's when I'm really going to have to seriously consider my short positions, okay, in the Nasdaq and in the S&P under duress, because the financials rallying back up, it's throwing caution to the wind in the financials, which means the S&Ps are extremely likely at that point to pop to 2450 without hesitation. Now, again, I'm trying to be very, very forward looking with this, and I want you guys to realize, again, the financials struggling at the 24 level, and any indication that they're going to not only sustain the 24 level, but actually pop above it is pretty dire if you're short markets. And that's when you actually have to reassess, the broader position out there. So hugging right up against this 24 level, and clearly yesterday making me a bit nervous there. However, closing down 4 cents, yeah, you kind of got to get that warm, fuzzy feeling off that one, because we have not been able to sustain the 24 level. Next in line over here, energy. Energy helped rally the S&Ps, okay? However, if you take a look at energy, and specifically we'll look at oil here momentarily, energy has been a one-way ticket. Like, I'm not that big about following a trend, but if the trend is your friend, oh, baby, it's to the downside over here. I mean, for all disclosure purposes, I do actually carry a short position inside of the XLE. Okay, I am short the XLE, have been short the XLE for a substantial period of time. I'm looking for a level very, very soon to cover the short position. However, this looks kind of like that quintessential bearish rally. And I think you'll agree inside of oil, which has been a precipitous decline. I mean, has this thing had an up day? Okay, sure. After it dropped all the way down to 44, and most of the time when you see this kind of wild bounce, this is a short covering bounce. There's a lot of shorts out there. All right, they bounce the stock, and again, it's very indicative, and it looks like based on the volume. Okay, a little bit of short covering, people then buy into it. Next thing, we're off to the races. One thing, be careful inside of oil. If you do trade oil futures, this is a stern warning to you. If you trade oil futures, the size of the move in the oil contract is almost enough for the regulatory bodies to change the margin requirements. It's a consideration if you trade oil futures. I've seen this movie many a time before. When you start exceeding expectations of movement ×3, then they're going to change the margin requirements. And Friday's move is right on the cusp of needing heavier margin requirements for oil. So know what kind of positioning you're in, because if you can't handle the heat, you're going to get knocked out of the box out there pretty quickly. All right, so big bounce in oil. Is there going to be follow through? Quite possibly. I'd look for Monday, Tuesday, continuation of bounce, but a lot of traders are going to look to sell into this once again. Now, commodities, that's been really the talk of the town. I know earlier in the week, sure, people are going to look at, what about Apple? What about Apple? Apple's right there with the Nasdaq. Okay, nothing more to be said specifically about Apple, but Apple is what's carrying the Nasdaq to, all-time highs over here. Again, it's hard to step in the way of a freight train, but you feel like in the Nasdaq, all it is a game of whack-a-mole. We're going to buy Facebook until we're not going to buy Facebook. Now we're going to buy Apple until we'll eventually not buy Apple, and maybe we'll buy Amazon. Okay, but no, Amazon's actually been down a couple of days in a row. Oh, look at that. 3 red candles in a row. Call Bezos. There's got to be something going on over here. Neither here nor there. Again, they're kind of playing whack-a-mole. And eventually, you'll see the Nasdaq have the absolutely horrific days that we all anticipate that are coming. Okay, last but definitely not least, and then we're going to go and we're going to look at the SPX forward into next week. Last but definitely not least, what really needs to be on your radar screen. Lots of people are looking at commodity products all of a sudden. Obviously, oil kind of rocked the boat a little bit. If you're looking at gold, okay, all right. Recent weeks, gold has actually sold off pretty much from the 1300 handle all the way down to the low 1200. Okay, 1230 over here. However, while people are staring at gold, they're actually missing the bigger opportunity out there. At this point, I'm not going to go out there and try to bottom fish gold. Why am I not going to bottom fish gold? I don't know. I opened up with like a 5-year chart. I'm like, yeah, it's down. Not really. All right, gold starts getting to like 1100. I might get warm and fuzzy, against gold, but I don't see gold as being the big opportunity. So I cruise down to the bottom of my screen, dig deep for this one. I started looking at silver. Why? Okay, and I'll zoom into this here momentarily. So you can look at silver, the futures contract, all right? Or, and this is silver futures, those are some big boy futures, or you can look at SLV, which is the silver ETF. So at first kind of blush, you look at this over 9 months and you're like, sweet, this is just a 9-month chart. And I'm going to close up this left side bar. It's a 9-month chart. It's one of the lowest prices it's been in the last 9 months. But then again, I opened up like a 3-year daily and I'm like, all right, it's been a little bit lower. But again, on a percentage basis, from 15 down to like 13, not half bad. Then, of course, I opened up like, the full Monty over here. And you recognize this really could be quite opportunistic. This is a 20 year weekly. And by the way, the product hasn't even been around like 20 years. So you're only going back. And if you follow the mouse over here, the product was launched in 2006. Now, silver as a whole, okay, and you can pull up the futures contract. And I was comparing and contrasting. You can pull up the futures contract all the way back to 1997. All right, it's been down to like $4. But the point being over here, for the most part, in modern times, okay, there really haven't been too many opportunities to buy silver down at these levels. Yes, okay, there were periods of time in 2014, 2015 over here where silver was down, but only a few, and again, I'm going to zoom in, only a few dollars lower than it currently is. However, okay, again, I think that silver is the most opportunistic at this point. However, I just don't think that it's completely bottomed over here. And I mean, this is a pretty wild down move. So what do you do if you want to start? And by the way, this is not so much of a quote unquote trade as it is going to be more, there's commodity bugs out there, right? I want to buy some silver for the long haul. But I really do think that this is a decent investment. That can you get whacked on it? Yeah, but by how much? I mean, is it legitimately going to go all the way back to $8 or $9? It could, but from a probability standpoint, I would say that the probabilities that are greatly diminished, as everyone in today's marketplace is always seeking out value. So the idea in here is there's not a lot of implied volatility at this point in time, but you can go out about a month, okay, and you can just nibble. Like these at the money puts, they're only trading for 40 cents. They're not worth a whole lot. You sell them for 40 cents though, that's getting you long silver at about $15.10. Not the end of the world, okay, decent, advantageous. But I wouldn't go out there and try to load the boat at this point. Because again, as I said, I don't want to miss silver, but at the same time, I don't want to step in the way of a fairly wild decline inside of silver. And again, this is a 3-year weekly. Open it up again. It just hasn't had any bounce. So go in slowly. If it backs off, again, I think it really becomes advantageous, starts breaking under 1450, and everybody in the world will be looking at it and looking to possibly acquire some silver out there. All right. Now, let's forward look at the coming week. What do we have in terms of the coming week? Well, one of the first things that we've got, right, is actually a decent expected move for the trading week. In fact, I have brought this up already in context of the chart, and I'll explain what I've actually drawn here. So this is the last 3 weeks, and everybody keeps sending me emails about this, but the last 3 weeks I've actually drawn expected moves. I believe this expected move over here was plus 47, minus $47. What did we do? We hit $47 on the button. The expected move for last week was just nominal. It was like a $20 expected move, plus or minus. We did not touch it, but we ended up on the week, okay, from the starting place to right here, we missed the expected move by $5. So we actually ended up on the week $15. And this coming week, we're starting right here, okay, $13.99.29 on the button. And what is the expected move? I don't see if it actually comes up over here. There we go. For 6 days, you're looking at about $31, $32, which is that $31 or $32 is vastly above the expectations from the previous week. Again, the previous week was a $20 expected move. The week before that, a $47 expected move. The impact, it does have something to do with the French election. It's not all packed into the French election, though, and I'll show you why. If you take a look at the expected moves for the week, all right, the SPX offers a Monday, Wednesday, okay, and a Friday expiration. And the irony is some of the biggest expectations of risk are even coming into the Wednesday expiration. So yes, the French election, but the French election is supposed to be over and done with out there. Not too many surprises. The interesting thing about the French election, when the news broke that there was a hack to the campaigns, the political campaigns were hacked over there, but the politics, I love this, by the way, the law in France, the political blackout was being enforced. For those of you, hey, I vote right now for a political blackout here in the US at all times. Come on. It doesn't matter what party you believe in, political blackout. Even we take off some of the news programs over there, we would all be that much happier. With that, the political, right before that political blackout and the news broke, the volatilities did pick up quite substantially. So, all right, we have the French election coming. Clearly, though, the market's anticipating a bit more risk on a $31 expected move. The funny thing is, all the conjecture about what you think is going to happen in the election, it doesn't really matter. You still wouldn't even know. Even if we said such and such is going to win, it doesn't matter. You don't know how order flow is going to play out. Was our election here in the United States not, evidence of that? Of course it was. So what you're looking at right now on the week, and I'll just mark it for you. Here we are again, just shy of 2,400. It's a move literally to 24.31, okay? Or a move down to what? 20, okay, 367. And that's roughly the expectations of risk. So again, which way are we going to go over here? Well, the trend is your friend. Is the trend in the S&Ps right now, is it truly up? Because here we have 1, 2, 3, 4, 5, 6, 7, 8. Okay, on the 9th day, we had a little bit, of progress to the upside. The trend right now inside of the S&P is over the last, 2.5 weeks of trade has been utterly flat. Clearly, the S&Ps are in ascension. However, okay, in descension over here is none other than the Russell, which during that same period of time has seen some sell side activity. Okay, then we get products like the financials that are actually caught in the middle, not necessarily trending up over here, but showing and displaying degrees of implied volatility. Again, one of the last looks I want to give you is this coming week. Once again, there is decent volatility being packed into the financials. In fact, the financial volatility is inverted. The financials seeing the most risk implied from, of course, this French election. So stay tuned, lots to think about. Again, don't forget some of the commodity plays out there, as we might just seeing kind of a dead cat bounce inside of the energy sector. Think about, silver. If it backs off at all, I'm going to be, on the bid buying some silver. Last but not least, Tesla, looking for entrance to a short position. Officially going to step up and short Tesla throughout the course of this week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.